Well, I'm really excited to be recording this for you guys today. Well, I was just taking my dog out for a walk and all these ideas start swirling in my head. So I know this is going to be very, very helpful. It's going to be a mini guide. So if any of you are ever interested in microcap stocks in any, for any reason, if it's something that you're really looking to pursue, if it's something that you just kind of happen to stumble into, I don't want to try to persuade you to go one way or the other. I'll say as a disclaimer, I don't generally buy microcap stocks, and you'll see why. But I'm going to show you a cool tool you can use that will really help you to be able to find good microcap ideas, give you some definitions on microcap stocks, and also make some conclusions and talk about how they're different from small cap, mid cap, large cap, those type of stocks, and give you some warnings. If this is something that you are going to pursue, there's a couple things you definitely want to listen to if you want to avoid, potentially huge losses. So let's just dig right into it. Let's get into it here. So to start, there aren't any concrete. This is one of those Wall Street terms where there's no concrete definition as far as I'm personally aware of, and things change as the years go on, but there's no hard and set rule where it's not like the S&P 500 or the Dow where a stock is either A, it's an S&P stock, or B, it's not an S&P stock, or like the Russell. There's no definite characteristic that says, well, this stock's a microcap and this stock isn't. I mean, in general, you can kind of say that, but there's no cutoff point. And the reason why I say that, and I will show you right now, if you Google microcap stocks, Wikipedia defines it as, you can see it says roughly, there's the key, right? Roughly $50 million to $300 million. So I kind of define it as less than $2 billion. I'll use FinViz, which is one of the tools that I talk about a lot when it comes to finding ideas for stocks. And the way that so it looks like, okay, they define it the same way as well, 50 million to 300 million for microcaps. I've seen it defined before as anything below 2 billion, with basically kind of shifting everything up. So I've seen microcap talked about up to 2 billion, small cap talked about up to 10, mid caps somewhere between 10 to 50, large is from 50 to 200 or 300. So it really depends. And, that could be I don't want to say generational, but it could be one of those things where maybe in the books, because I know I've definitely seen small caps and stuff like that referred to in these books that were maybe written in the 90s or the early 2000s. And they definitely, when they are talking about what they call small cap, they're defining it differently than how FinViz or Google is defining it today. Recording this here in 2018. So, it might have something to do with what year we're in. And who knows, maybe sometime in the future there's going to be a definite range that says, okay, officially this is what makes a microcap stock. But as for now, we have roughly 50 to 300 million. So that's kind of what we're going to talk about today. I'm just going to say just general area, right? Really just focus on that. So, you start to talk about what are some of the pros and cons of a microcap stock. An obvious pro would be okay, because it's so small, it has a potential to become, it seems like it would have more potential to become a 10 bagger, definitely more potential to become a 100 bagger. If you have a stock that's already trading at $100 billion, let's say an AT&T, for example, they might be at 100 billion or 200 billion. For them to grow 100 times, become a 100 bagger, they would have to have a market capitalization of $10 trillion. And that's half of the US GDP. Does that sound reasonable? Does that sound like it can happen? I'm going to say no. But, for a stock to start at, let's say, 300 million and become a 100 bagger, now it's a $30 billion. I think that's very possible, and I'm sure it's happened before. So, it's not unreasonable to think that there's a higher chance at getting a 100 bagger or a 10 bagger from a microcap stock than a large cap stock. Now, that being said, there are some obvious cons as well. And you can easily Google this stuff, and they'll give you kind of, there's some good definitions in there. I want to talk about a few that I definitely saw and might not agree with 100%. So they say, because it is smaller, there's gonna be less liquidity. So meaning, when you say liquidity, the way the stock market works, if you don't know, people are buying and selling shares. When you sell a stock, that means there's always a buyer on the other side. And so the broker is becoming the middleman, and there's always a buyer for when you sell. Now, when you sell a stock and there is no buyer, that's when the stock price drops a lot until somebody finally buys. When there aren't as many shares outstanding as, let's take a simple example, right? Just real simple. Let's say a microcap stock, and we're just going to pick from the top. Let's say AAC. And then we're going to compare that to, let's say, a mega stock, which is, 200 billion or more. Let's compare that to Apple. Now look at the shares outstanding here. AAC only has 24 million shares outstanding, whereas Apple has 5.12 billion shares outstanding. So to sell one share at 176 of Apple compared to one share at 1171 of AAC, it's probably going to be easier to get a buyer much faster when there's a higher amount of shares outstanding. And so the chances of you, let's say, putting a trade in with your broker, let's say you put it in at 177, they could probably execute at 176.50. Whereas, I'm not going to say that exactly what happened, but for an example, if everybody's selling AAC at the same time and you put in an order for 11, it might get executed at, like, let's say 9, compared to like Apple, where you could get it executed within like 10 cents, 20 cents, 50 cents, whatever. Just as an example, okay? So that's the general kind of first con that people mention when they talk about microcap stocks, is this liquidity issue. And yes, I understand that does become more of a potential issue as you get further into a bear market. However, it's not really something I'm too concerned with, because the shares outstanding on these stocks, on the micro stocks, can really vary depending on what company you're talking about. And, although, it might not be as liquid as an Apple, your big risk is going to be low liquidity because the company is like going bankrupt, right? Or having like huge 75% plus crashes. And if you're picking stocks that run into that situation, well, that's going to be your fault. And liquidity is probably the least of your concerns, and it wouldn't matter much anyway. You're still going to lose a ton of money. So that's kind of why I sort of disagree with the whole liquidity problem that people like to bring up about microcap stocks, because, like I said, it's not, there's other things to worry about when it comes to microcap stocks, and that shouldn't be one. Okay, so now saying that, another problem that people have with microcap stocks is that they say they are very volatile. And this is 100% true. And it's kind of, I want to talk about why A, it doesn't matter, and B, it does matter. Might be kind of confusing, but you'll see in a minute, okay? So, and I'm so curious if they have like beta for FinViz. By the way, this is FinViz. I mentioned, yeah, here's beta. I mentioned at the top of the video that, I have a tool you can use if you're looking for something to help you with sourcing microcap ideas. And I just showed you how you can do that with FinViz. You would go over here to Screener, you would click Market Cap, and then right here, you could go small or you could go micro. That's going to give you a list. Look right now, 1,015 stocks to choose from. This is all like NASDAQ and NYSE stocks, which is what I dip my toes in. So it's what I know about. It's what I can talk about. So there's a list right there. That's a great place to start. And there's just a ton of different ratios and valuations you can use to start to narrow that list down. Now, back to my point about volatility. If you know anything about beta, beta is a measure of volatility. It is comparing the volatility of a stock, of the history of a stock price, to the volatility history of the overall stock market. So anything above 1 means a stock that's historically been more volatile than the market. Anything below is less volatile. Now, let's again make a comparison between megacap and microcap, okay, from FinViz's definitions. Now we're looking at beta. Let's take out any betas that are at or below 1. And, there we go. So let's say anything over 1 is what we want to look at. So we went from 13 to 28. So roughly, what is that? A little less than half of these stocks are more volatile than the overall market as defined by beta. Now, if we go over here, the micro, you see 1,015 stocks. Let's do the same thing where we want to see any stock that is higher in volatility than the market. And we went from 1,000 to 294. So, kind of proves my point, right? Are these stocks really more volatile than... say hi to everybody, Jesse. Good job. Are these stocks really more volatile than the market? And I would say, based on this, not necessarily, because less than half of these microcaps are also less volatile. But, you have a spectrum, because... Hey, knock it off. That's enough. He gets really protective of me and my space. Any little walking that's done outside, and my dog freaks out. If you guys can even hear it in the background. So we have less stocks that are more volatile than the market, but we also have a higher rate of volatility on the stocks that are more volatile. So look at these betas of 4, 3, 2, whereas everything here is around the 1 to 2 range. So it's like yes and no, right? Kind of more volatile, kind of not. Depends on how you're looking at it. If we look at betas under 1, you see a lot of them are just right at the market beta. And I don't know how this beta is being calculated 100%. Like what time frame are they making beta? Is that even something that's a general standard? I don't know. I don't use beta too much, but I do know about the fact that it can be a way to measure volatility over the history of a stock. So that's one thing, right? The second thing is I want to show you a personal example of how basically how I got burned buying a microcap stock. So go over here to my broker account. This is one of my fun money accounts. This was the year 2014. This was a microcap stock I bought, NAUH. I want to show you what it's done since then. You see this chart? So I bought it around 3 and it's now at like $1. And I wanted to kind of use this video as to make my mistake maybe your learning lesson. And we'll look at the financials real quick of what the stock had. And I think it can kind of show that even though a stock might look great from a value perspective, it has a lot more inherent risk just because it's a microcap stock. And I know a lot of you might not want to hear that, and I apologize. Obviously I like to keep things positive, and I like to, if you know any of my videos, I'm always saying, I'm always trying to be empowering. You can do it. You can do it. You can make money. It might be slow. It might take longer. You can make money. Learn how to value these stocks, and you'll do fine. However, from my own personal experience, from what I've observed in the market, there is a lot of risks that come with buying these microcap stocks, even if you use measures that are generally considered to be prudent, generally and historically have worked for a lot of investors like Warren Buffett, Benjamin Graham, Seth Klarman, Joel Greenblatt, Peter Lynch. They've used these metrics to great success. However, they did not dip their feet and their toes in the microcap space. They were looking at, small cap, mid cap, or higher. And so, before I move on, by the way, I want to give a shout out to longtime customer Mason. He's a e-letter subscriber and Value Trap Indicator client. This is actually what prompted the video. And so we're going to look at my mistake, and then we're going to talk about his stock that he's talking about in this email, and we'll kind of look and see if we can see any similarities, right? So I removed some of, I removed his last name. I removed some other stuff in here to keep it from being too sharing. But basically he said, hey, Andrew, I've got a question. I want to get your thoughts. I recently was doing a screen on Finviz and changed my market cap range from 2 billion plus to 300 million plus and found ticker EVC with 400 million in market cap. It has one of the lowest VTI scores I've seen, around 95, with 8 years of dividend payments and on the 4th year of increasing his dividend. If you could give them a look, I would appreciate it. Sure, that's what we'll do in this video. The e-leather pick this month I just recently sold because of a trailing stop. It hit around 63, so I was going to try for another stock rather than getting back in at 69. If EVC is not viable, I will go with, and then he put ticker symbol here, which is for paid e-leather subscribers. This month, as I joined the e-leather after it had been recommended, and its VTI is also good right now at 95. Thanks as always, Mason. So VTI, that's my valuation spreadsheet. It's what you see pulled up here. It's how I value stocks, and anything below a 250 correlates to a strong buy. So it's every single stock I ever buy has, in my retirement accounts and the money I'm seriously investing is going to have a strong buy VTI. And it uses a lot of different metrics. You can see price to book, price to earnings, price to cash. And there's a lot of other stuff that goes on down in here that's for clients. But it's been, a very useful tool for finding stocks that are generally undervalued. So let's look back at my account history back in 2014 with my fund money. I bought this at 386, and you can see I bought it March 24th, 2014. So let's look at the latest annual report that was available at the time. So if we're looking at March 2014, that means we're going to want to look at March 2014. Is that what I said? Yeah. So this one that's already passed. So that's after I bought. So this is going to be the latest one, August 2013. And it really brings back memories, to be honest. I was so excited about this stock, guys. But I knew that it didn't fit in with my principles. My principles are always buy a stock with 2 billion in market cap or above. Around 1 billion is still okay, but I never dip my toes in microcaps and nano caps and stuff. And so I was like, okay, well, it's some fun money, so who cares? And, luckily I did do it that way. But as we saw, it's, I did get out. I did get out, so I'm not still holding it, thankfully. But I call it a good learning experience. It was a good tuition in the School of Hard Knocks. But, a very cheap tuition considering I only put a couple $100 in, and it was just fun money. And, I didn't recommend it to anybody or anything like that. So just really happy I stuck to my principles. And we can all learn from it and laugh about it today. So I believe they did pay a dividend too. If you're not able to follow along as I'm doing this stuff from the 10K, just go ahead and check out my 10K tutorials. And let me know in the comments if my dog's annoying or if that's just me. I'm keeping my cool because I'm in front of an audience right now and I have to keep my cool so I don't look like a monster. But yes, my dog loves to bark. He's a mini dachshund, if anybody's wondering. They bark at pretty much anything, especially the mailman, especially the pizza delivery guy. He's never bit a person, though. So anyway, yeah, the 10K tutorial, that's where you're going to want to go. I have a playlist with the 10K tutorial. If you're struggling with, what are these numbers he's putting in? How is he finding them? I really go in depth with that in those tutorials. So check that out. But this is how I'm going to show you how, how I kind of valued the stock back in the day and some of the thoughts I saw. So when I'm filling out a VTI, I also try to get 5 years of earnings data. So I'm going to take this back 2 years from where we were. We were at 2013, so let's go to 2011. And we'll take the 2010, 2009 earnings. And just plug those guys in. Okay. And then let's look at what the share price was back in the day. Good old Google. I wish Google would expand their Google Finance more, because it's like the best option out there, really. Way better than Yahoo Finance. Oh, I can use the share price that I bought at. 387. Okay, so you see my value trap indicator here is 174. And so what that tells me is that pretty much every valuation metric looks really strong when it comes to this microcap company. If you look at growth, yeah, we kind of, it jumped up here these 2 years, and then it crashed down. And then from here, it looked like it was coming back on a rebound, 8% growth. That's great. From a price to book standpoint, you're going to get plenty of assets. If you look here, lots of assets compared to liabilities. The debt to equity is below 1, 0.73. That's fantastic. The price to earnings, you're getting, even though the earnings aren't as nice as they were in 2011, 2010, you were still getting decent amount. And that was a good PE even back in 2014. And price to cash, plenty of net cash to, theoretically weather a storm, assuming the rest of the business doesn't collapse. And so, from a bunch of metrics, it just looked fantastic. If we fast forward to today, let's look at their latest annual report. And, if the stock price crashed that much, from 3 all the way down to 1, I'm willing to bet that the business is not nearly as strong as it was from a financial standpoint. And, obviously that's one part of being a value investor, but I really do think that being a microcap had a lot to do with its downfall as well. So if we look here, the shareholders equity, latest one's 29, about 30 billion. That's 20 billion less than what it was 4 years ago. That's not good. And the earnings, you can see, wow, last 3 years they had negative earnings. Well, last 2 years they had negative earnings, and so it looks like they grew in up to 2015 from that kind of $5 billion mark, got up to like 6.7. But then they spent 2 years of negative earnings. That's probably what really drove the price of the stock down. Excuse me a second. I really liked the dividend when I was looking at this, and I was reinvesting shares. I was getting a bunch of shares. I thought I remember the yield even being much higher. I think it climbed higher because the price continued to drop. But if we look at their dividend history, I'm sure we'll see that they didn't pay as many dividends as they did previously. Yeah, if you look, 0.045, if we multiply that by 4. So I guess they did grow it barely, but this isn't a business you want to be in any longer. 2 years of negative earnings is a terrible, terrible indicator of the health of a business. And so you definitely want to keep away from that. So now the reason why I make all those points, right? It's because I really want to stress the risks in buying microcap stocks. And this is a big one. The fact is, before a stock gets to like billions of dollars, $1 billion, $2 billion, you're not going to get as much safety from it. And that's something that's kind of talked about a lot. And so when I mentioned earlier about the volatility stuff, you know, I think it has some truth in the sense that the business results are more volatile. And so you can get a stock like this, like a National American University Holdings, and you can get the business where everything looks great and everything looked fine, and then all of a sudden it just all comes crashing down. And so, you know, it's really hard for these stocks to compete. As much as we don't like to admit it, you know, the big fish get bigger, the small fish get swallowed up. Some of the small fish get lucky to get swallowed up and become part of a big fish, but some of them just, you know, they don't get fed anymore, and then they deteriorate. And that's kind of what we saw with a stock like this. And a lot of stocks, you know, I don't want to, this is maybe a topic for another time. I will show you one article I did. Now, I've referenced this before, and it's one of those, and I'm going to be doing a lot more of these type of going back in history and taking some just looking at simple history, you know, like research, but research that's not complicated. We don't need a PhD to do this research. Just simple database research, and find out some things and make some conclusions about some of the winners and some of the losers. I tried to do that with Value Trap Indicator with the losers. There's always room to do more of that, and obviously the winners too. So, like, I don't know if you can see this. My monitor kind of cuts out at the very end. Here's dividend success case studies. So I cherry picked this, but this is good examples of stocks that did really well, right? And continue to do well for 25 years plus. And I'm in the middle of another spreadsheet right now where I can really take this to the next step. There's like 200 stocks on there. I probably won't examine every single one of them, but there's a lot of good data in there as well. And I'll be sharing that in a little while. But, you know, these three stocks, if you look at them, the results were crazy, right? 10,000 turned into over 100K, almost $1 million. Here's like a 7Xer. That's great. Looks like a 30-year type deal, right? And if you look at what they're, you know, what were they? Were they microcap? Were they small cap? Were they mid cap, large cap? Something you have to take into consideration is like inflation. So I inflation adjusted these because, you know, 21 billion back then is a lot more than 21 billion today. So in 1987, when you first bought these stocks and then held them for 30 years. So you can see a lot of these stocks are already pretty big. Okay. Walmart, 45 billion. Now it's at what? I don't even know, 200 plus billion. Yeah, 250 billion. So there's a 10x. There's a 10 bagger. So inflation adjusted 45. We were looking at a mid cap range. Coca-Cola back in 1987, still mid cap. Abbott Labs, mid cap. MO, PG, all mid caps. You see that? That's pretty telling if you tell me. There's one more kind of research thing I did that I'd love to show you guys, and it's gonna give us a similar conclusion. If I can remember where I put it. Okay. Pretty sure it's characteristics. If you don't know where I'm at right now because you're new to the channel, my name's Andrew Sather. This is my blog, investingforbeginners.com. It has a lot of great information and research in addition to the YouTube channel. So here we go. This is one based on Sure Dividend. Our friends over at Sure Dividend, they did some research on some stocks that returned over 12% a year for a long time. It was 25 S&P stocks over the past 25 years, and they all returned 16 or more percent over this 25-year time period. So here's some of the data I pulled from, again, what were their stats before these 25 years of serious growth. Here they are, and I cannot remember if I inflation adjusted these guys as well. But regardless, if you remember the last article, it was like maybe like a 2 times difference. So we're not talking about like the difference between in scale of like a 10, you know, where it's like, oh, because of inflation, this was actually nano cap, but now it's a small cap. We're talking about like, okay, maybe this 11 billion was 5 billion, which still makes it technically mid cap or small cap and not micro or nano, right? So look, 11, 3, 2, 0.9, all of these, not one of them is below a 0.9. So I kind of talked about how my cutoff in a sense is 2 billion, but I'll sometimes dip down towards 1 billion. You can see here, these are all the best S&P stocks over the past 25 years. Not a single one started as a micro or a nano. And I think a lot of that has to do with the big fish, small fish type thing. A lot of that has to do that, you know, at a certain size, and it's all dependent on industry and stuff, but a lot of these financials just, they need scale and they need size to really make kind of a solid place in the marketplace. When you think about market share and, you know, saturation, customers, demand, all of these things, in order to really be like a dominator in an industry and be like have that position in the marketplace be really dominant, you're going to have a large market share, and you're going to have basically the numbers to back up that large position, right? That large kind of leadership in the marketplace. And from what we've seen in the past so far, it appears that, you know, being in a microcap or nano cap kind of scale isn't enough to really cement solid financial status when it comes to being a dominator in the industry. And if you think about, you know, how is a stock going to grow and outgrow the market and really do really, really well compared to everybody else? Well, it's got to be a dominator in its industry. Likely it also has to be in a growing industry, things like that. But, you know, it just hasn't been there. And for whatever reason, that seems to be the number for now. And so I showed you, you know, how I dipped in, and this, you know, now it's at 18 million for market cap, which is tiny. But back when I bought it, it was about 100 million. So still, like, I guess technically a microcap from how FinViz kind of defines it. So that's kind of my morning. I mentioned, you know, if you're going to look at microcaps, I think FinViz is a fantastic resource for that, fantastic tool. Be aware of the pros and cons, and, you know, take my lesson to heart and really beware of these risks. You know, if you want to take little position sizes in these, I really don't see a problem. But when there aren't steady, huge assets, huge capital, you know, big earnings numbers, it's really hard for these companies to compete. And you can really get into a situation like this where, you know, to go from 100 to 18, that's like an 80-90% drop. That's going to hurt really bad. And then, you know, I made a spreadsheet today, and I wanted to look at, because, you know, I've been running the e-letter that I talked about where I'm recommending a stock every month. Never once, like I said, recommended a stock that was a microcap in the e-letter. Been doing it since 2014. And I ran a spreadsheet earlier today because I wanted to look at all of my sells, because, you know, generally I'm buying and holding, but every once in a while, you know, I'll hit a trailing stop or have some other reason where I'm selling. So I tracked all my sells, and I tracked how they're doing today. And I believe like the worst case was maybe like a 30% drop for like one stock. Everything else was mostly up, which was disheartening to see because, you know, that means I missed out on a lot of gains. And, you know, I think a couple were in the 25, 20, maybe 15 range. But never once have any of my buy recommendations, you know, up to this point from 2014 to mid 2018, never once has anything been more than a 50% drop, more than a 75% drop, certainly not more than an 80 or 90% drop. And, you know, yes, there's obviously going to be cases where when there's a bear market, I'll probably have a bunch of stocks that lose 50%. But we're talking about in the middle of a raging bull market where everybody around us is making money, business is flowing like crazy, and then you have a stock like this. What do you think that's going to do to your portfolio? Do you think you're going to be able to catch up with the market when you have a stock that goes like this while everything else is going up? It's just one of those risks and something you have to be aware of, and something that I really, really caution. If you are going to take those risks, make sure you're doing really good due diligence. Make sure you're really looking at and you understand the industry and you understand financial statements. You understand what these numbers are really telling you about, and you understand this phenomenon with big fish, small fish. But let me finish answering Mason's excellent question, and then I'm going to wrap up. So he found ticker EVC. Go ahead and we'll do the same thing, right? We'll do a value trap indicator for it. Don't save. And so let's look at what Mason was talking about and see what kind of numbers it pops up for us. Was it EVC? Yeah. So it was broadcasting. That's pretty interesting. And I love the initiative that he's taken to find these companies, The thing about value trap indicator, I don't necessarily think that one that has a lower value trap indicator would be a better opportunity than another. I think as long, the way I structure it, this is advanced for those of you who are VTI clients. The way I structured it is not so much, it's margin of safety with an emphasis on the safety. It's not so much emphasis on the margin. So I do sometimes give higher preference to really low price to sales and price to books, but it's just, you want to be generally undervalued in those metrics. And you want to just make sure that no metric's too high. And just because you have a really, really super low PE or PS or PB doesn't mean it's a better opportunity necessarily than one that's just kind of average all along, but still like a value trap indicator strong buy because it has good metrics across the board. All right. Let's analyze this guy. Revenue. Top line. Earnings, bottom line. You see a big jump there. I mean, that looks good, obviously. Make sure you're taking diluted EPS. Remember, you mentioned the dividends, which are increasing. That's really cool. And I think, like I said, if you got your diversification straight, position sizing straight, I think it's okay to take higher risks for higher potential rewards. But I think a big component of this, outside of financial statement analysis, that you don't really need to consider too much when you're buying small cap, mid cap, large cap stocks, in my own opinion, my not so humble opinion, right, is that you're going to need to also do industry analysis, competitor analysis, if you're even thinking of doing a microcap stock. I think that's going to be super important, and try to see how small of a fish this particular stock is that might make somebody a lot of money, right? Hopefully I'm saving some of you a lot of money as well. And then let's make sure we have 5 years of earnings, like I mentioned. Almost done here. Good thing the dog calmed down. The stairwell's kind of echo, so if someone's just walking up the stairs, he freaks out. It's all, he's got good intentions. He's just trying to keep homeboy safe. I respect that. Okay. So remember Mason talked about how the VTI was really high. I mean really low. Might help to have the share price. I think my dog knew I was talking about them because now he's licking me, licking my feet. All right, 450. Yeah, that's insane. You're almost getting the business for earnings. I'd look into this, right? This is a lot, and it just came out of nowhere. But actually, if you look at 2013, it looks like they had 3 terrible years. And then now in 2017, they're kind of getting more back to normal profitability. So I don't know what like the return on this would be. Might as well just show you guys. Every little detail I can give in these videos is some of you are going to learn something on each of these little things I do that you weren't previously aware of. So I should be doing this. Okay. This is how you can kind of calculate how much it's grown. Like if we're just ignoring the 3 years, right? And like, okay, really what was this growth from 2013 and 2017? You're going to want to look at compounded growth. That's different than average growth. One of these days, maybe I'll make a video about the differences, but it is an important difference. So really you're talking about, if you just ignore the 3 bad years, then we're looking at earnings that grew at like compounded rate of 7.13%. Is that good or bad? You know, there's nobody, again, who has a black and white definition. I kind of like to compare earnings and dividend growth. As fair or unfair as it may be, I like to compare it to the average stock market growth of 10% over, you know, the market's grown by that much over the last 90-year plus time period. That's been kind of the average. Call it unfair, and it's not based on any research, but that's just kind of intuitively what makes sense to me. And I don't hear anybody really say that or talk about it in the book, so take it for a grain of salt. As we all know, growth is subjective. But that's something kind of interesting to note. 7.13%. This is okay. So is this growth really as great as it seems? Yeah, now that we have some context, we're looking at more history. Maybe not so much as you previously thought. The 2.3, I mean, you're almost, you know, what was the market cap on this? So 400, you're paying $413 to get 176. That's crazy, right? And then price to cash, you're almost getting this business for straight cash. That's really cool too. However, remember what we saw with National American Universal Holdings. You know, what happens if their competitor just blows them out? What if they have a better product? You know, I mentioned like broadcasting, so I don't know how that industry works necessarily. But, you know, at that size, you know, is it really a market player? Does it have staying power? I know it's a lot of like kind of qualitative, not quantitative stuff, but I think that's really something you have to consider. The smaller and smaller you start to target these stocks. With bigger stocks, you kind of have the luxury of, if they're at 2 billion or above, there's a good chance, you know, I don't have data on this, but there's a good chance that they have staying power in the market. But in these microcap situations, you're going to have to be really, really careful. And so that's the last thing I'm going to say about all of this. Keep that all in mind. Hopefully it was helpful. If you liked the video, hit like. It's going to help me determine what kind of videos to make in the future. So go through the video library, hit like on any of the types that you like, and I'll have a better understanding of what kind of videos people like and what kind of topics I should maybe go more in depth into. So, as always, you got 3 options from here. Subscribe to the channel, click the bell to get notified whenever there's a new video live. Option number 2, subscribe to the email list over at stockmarketpdf.com. You get a free ebook and get daily tips. Obviously, I also have my website, einvestingforbeginners.com, where I also talk about that ebook, Getting Started for Beginners. That's a great place to start. Option number 3, check out the playlist I created on the channel called How to Analyze a Stock Using Valuations. It's a very, very helpful resource. It help you clear up, if all these numbers all look like gobbledygook to you, that playlist and the ebook I mentioned that's for free at stockmarketpdf.com. Those are resources that can really help you understand. Then you can start to get to a level like Mason, who has been a long time subscriber client and is able to find these stocks on his own and not have to rely on, another person or another website, and able to ask really intelligent questions and able to comprehend and, really pick up this skill of evaluating and finding good potential stocks that can build his wealth. And, it's a skill he can take with him for the rest of his life. So kudos to him. Hopefully you guys can pursue that path if it's something you're interested in as well. And the resources I recommend, I really recommend them really, really passionately and really, really thoughtfully and deeply, because I really think they can help you if it's something you're looking for. Stop working for money. Put money to work for you. Thanks. I will talk to you next time. Peace out.